Hi there, welcome to Kneppy Invest. Well over 10 years ago, when I first started investing on the ASX, I drew up a watch list of companies I would love to own for the long term. Unfortunately, this watch list only consisted of ASX companies because I only invested in ASX companies. However, recently, after changing super funds, I am now able to trade or invest in international exchanges. So that includes NASDAQ, New York Stock Exchange, the FTSE, DAX, the Nikkei, the Hang Seng, and many other international exchanges, including Switzerland. I forget what that's called, and also the French. And one of the reasons this is really exciting to me is because the amount of high quality companies on the ASX dwarfs, actually, it's the other way around. The number of high quality companies on the international exchanges absolutely dwarfs the number of high quality companies on the ASX. And that's understandable because Australia is really small compared to the rest of the world. And so the majority of high quality companies are listed on international exchanges, not the ASX. So the whole world has opened up to me over the past 18 months after changing super funds. So I've drawing up this watch list of high quality companies on the ASX. Now, in today's video, I'm going to be focusing on companies that are listed on the NASDAQ and New York Stock Exchange. So no ASX companies focused or featured in today's video. Now, the majority, or say most of these companies that I'll be talking about today are not necessarily companies that I would want to own for the long term. However, they do look interesting based off their technicals. And just because I might not want to own these companies for the long term doesn't mean you won't want to own these companies for the long term. I'm trying to share ideas with you, the viewer. And sharing ideas also includes sharing ideas on companies that I have no intentions of buying into at all. So, in fact, I will be featuring 9 companies and 1 ETF in this video, including Credit Suisse. Now, the reason I'm including Credit Suisse is because this company has been in the news quite a bit recently. I haven't been really following the news. There's been talks of the company potentially going bankrupt. Now, one of the reasons I don't really follow Credit Suisse all that closely is because it's a bank, and I'm not really a bank investor for the long term. I will trade banks in the short to medium term, but I don't believe banks are long-term holds, simply because the majority of banks aren't growing all that quickly, if at all. So, what are the other 9 companies and ETFs I'll be featuring in this video? Apart from Credit Suisse, I'll also be looking at Amazon, Under Armour, Block, Adobe, Zoom, Qorvo, Spotify, Intel, Visa, and the one ETF is Ark Innovation Fund. So let's get stuck into it, focusing on Credit Suisse initially. Credit Suisse, to my surprise, is actually listed on the New York Stock Exchange. I thought maybe it would have been listed on the Swiss exchange, but maybe it is dual listed. Market cap, 11.5 billion. P ratio is negative because they were loss-making in the previous financial year. And then you look at the revenue. So one of the first things I look at is revenue growth. Does a company have revenue growth over the 3, 5, 10-year period? And if it doesn't, that is a bad sign moving forward. It's an automatic red flag. And for Credit Suisse, the 5-year compound annual growth rate in revenue is negative 3%. And then you look at the chart. This is the weekly chart for the company, and the share price is in a well-defined downtrend. At times, the share price is in a short to medium-term uptrend, hence why I tend to focus on the short to medium-term when you are looking at banks. But then you look at the share price drop since 2007. It has fallen 95% since then. This has been an absolutely horrible long-term hold. If you have been a shareholder in this company over the past 15 years, you have lost the majority of your capital in this company. I see absolutely no reason to take a position in this company, even if you do think it's cheap, because this company is going backwards in terms of their fundamentals. Revenue has been decreasing. Company is loss-making at this point in time. Now, the only positive thing that I could even think about when I look at Credit Suisse and this particular chart and their financial state is a significant increase in volume over the past 9 to 10 months. That is telling me that there is some interested people in this company right now, interested fund managers, and the significant spike we did see in this company 2 weeks ago is another interesting thing. But that could be just leading to a short-term bounce in the share price, maybe a short-term rally in the share price, but that's about it. I have no desire to buy into Credit Suisse for the long term because everything looks down to me. Before we have a look at the next company, in fact, the next thing we're going to look at is the Ark Innovation Fund. So I want to talk about this open letter from Ark to the Fed saying they're making a horrible, horrible policy error that will cause deflation. And so the Fed just raised interest rates by 75 basis points, and Ark, and that's run by Cathie Woods, is saying they are making a mistake. It's all about deflation. We are seeing indicators that show us it's going to be deflation. That's the problem moving forward. So you're focused on inflation, but it's going to be deflation that you should be concerned about. Why are you raising interest rates? This is what Cathie Woods and Ark is telling the people of the world, and they've been telling the people of the world that it's deflation that's going to be the problem. And they've been telling people this for the past year. So even though we have seen significant inflation, Ark has been solely, and Cathie Woods have been solely focused on deflation. You don't believe me? Well, here is a tweet from Cathie Woods exactly 1 year ago. And I do read a lot of Cathie Woods stuff just to get a different perspective because I find her investing style to be interesting and unique. But on October 25, she sent out this tweet. And you have to go back to 2008, 2009. And she actually does mention she made a mistake. So in 2008, 2009, when the Fed started quantitative easing, I thought that inflation would take off. And actually, a lot of people thought that. I was wrong. Yes, you were wrong. Instead, velocity, the rate at which money turns over per year, declined, taking away its inflationary sting. Velocity still is falling. This is back in October 2021. So she's saying velocity is falling, which is not going to lead to inflation. It's going to lead to deflation. That's what she's probably thinking. Now, her reasoning is all wrong here. And her thought process is all wrong because back in 2008, 2009, that quantitative easing wasn't aimed at individual households. It was aimed at banks and those financial institutions. So they got all the money and people like you and me got nothing. Well, in Australia, we did get something, but the majority of people around the world got absolutely nothing. And that's why there was no inflation. Now, what has happened over the past 2 years with all this stimulus, who had that been aimed at? Well, it's been aimed at businesses and financial institutions, but a lot of stimulus has been aimed at household, and a lot of money has been sloshing around, and there is demand pressure right now. So we have supply pressure, supply side driven inflation, but we also have demand driven inflation as well. So 1 year ago, this is what she said. Now we believe that three sources of deflation. So at this point in time, 1 year ago, they were still thinking it's going to be deflation that was going to be the problem. And so deflation will overcome the supply chain induced inflation that is wreaking havoc on the global economy. Two sources are secular or long-term, and one is cyclical. Technologically enabled inflation is deflationary and the most potent source. So she's really harking on deflation. And the reason that Ark and Cathie Woods are only talking about deflation is because her holdings she has will absolutely benefit from deflation, and they'll absolutely not benefit from inflation. And that's why I really am focusing on what's happening with the Ark share price or Ark Innovation share price, because it has absolutely gone down. Now, it's understandable why they would be concerned about inflation or deflation. Not concerned, they would love deflation. But the reason they think it's going to be the deflationary environment is simply because, as I mentioned, her companies that she's invested in will benefit from that. And I think she's doing this all wrong. So what you should do is look at the factors, the macro and microeconomic factors, and then invest based on those factors. But she's done the complete opposite. She's bought into companies she wants to own for the long term and then adjusted what she thinks the macroeconomic factors should be so her portfolio can perform the best or better than the majority of funds out there. And that is how that is why she's wrong on her thinking, is because she's got this twisted around and she's just thinking This is what's going to benefit me and my portfolio. Deflation. That's what the Fed should be focusing on. Deflation and the problems of deflation. And that's why raising interest rates is all wrong. She doesn't want interest rates to rise. She wants interest rates to fall because, again, her portfolio and her funds will benefit from that. So why have I included Ark Innovation Fund or ETF in this particular video? The main reason I've included this company and quite a few other companies in this video is simply because of resistance and support levels. Resistance and support levels, in my opinion, are the strongest technical signals, particularly when there is a breakout above or below support or resistance levels. And $36 was a really strong support level for Ark Innovation ETF, which goes all the way back to 2018. So this particular chart is a weekly chart of the Ark Innovation Fund. And at $36, between 2018 and 2020, in fact, the COVID-19 financial panic, every single time Ark Innovation Fund hit $36, we saw a bounce. And this is all psychology based. It's all about, some people might call it self-fulfilling prophecy, but a lot of traders out there know where the support and resistance levels are. So back between 2018 and 2020, a lot of traders knew whenever Ark Invest hit $36, it bounced. So when they saw the share price get towards $36, they would start buying, and that's why you saw it bounce. So $36 held firm from 2018 all the way through to May of this year. Now, in May of this year, in 1 week, we saw Ark Innovation Fund hit $36 and then rally significantly off that level on really high volume. Now, that's the most important thing, really high volume. The other thing is, if you look at that weekly candlestick, there's a really long tail to the downside. That's telling us there was a lot of buying during that week. And the most likely reason there was a lot of buying is because for a brief period, the Ark Innovation Fund hit $36. And then 5 weeks later, it hit $36 again and then rallied. But in the past week, what has happened is there has been not enough buyers. So all those who were buying Ark Innovation Fund because it hit 36 have been washed cleaned of the system. They're no longer willing to buy Ark Innovation Fund because it hits that support level at $36. And thus, Ark Innovation Fund share price has fallen through that support level on strength. I would like to see a little bit higher volume for confirmation, and I think we will need to wait the next few weeks for absolute confirmation that $36 support level for Ark Innovation Fund has been broken. And this is a very, or possibly a very bearish signal moving forward for this ETF. I could not help to include this particular tweet from Michael Burry. If you don't know who Michael Burry is, I highly recommend watching The Big Short. So that's a story about what happened during the GFC, and quite a few people shorted the housing at that point in time, including Michael Burry. So that particular film also had Steve Carell, Ryan Gosling, and the person who played Michael Burry was Christian Bale, or as I call him, Batman. Anyway, this particular tweet from Michael Burry was aimed towards Cathie Wood and Ark Innovation Fund, or Ark Invest. This was coming because it had always been this way before. How anyone over the age of 40 did not see it coming is a riddle, the answer being greed. And he included a chart of the Ark Innovation Fund. You can just see that mountain. So it rose up a huge cliff, it seems like a cliff, and then has fallen back all the way down to where it started. And now the share price of Ark Innovation Fund has fallen below that support level, and more than likely the share price of Ark Innovation Fund is at least a 5-year low. Again, a 5-year low. Maybe the bottom is soon reaching for the Ark Innovation Fund, potentially if the bear market is coming to a completion. But I love these sort of tweets for Michael Burry, so keep them coming. Now on to Amazon, listed on the NASDAQ, market cap 1.1 trillion, used to be nearly 2 trillion, I think, at one point in time. Apple is still over 2 trillion, if I remember correctly. P/E ratio 100. I ignore P/E ratio for Amazon, but the 5-year compound annual growth rate in revenue 26.7%, and more than likely that's going to continue. Maybe not that high over the next 5 years, but it's still going to grow. This company is still going to grow. I think at one point in time, this company might own the world, but the share price has dropped 44% since November 21. So for those who would love to own this company for the long term, potentially your time is right now to take a position in this company. The reason I have included Amazon is because it actually does look quite bearish. So there is potential more falls in store for Amazon, but it is approaching a pretty good support level at around $102. The reason that is a good support level, and that support level goes all the way back to 2018. If you look at 2018 and 2019, the share price really struggled to get above $102. Back then, it was a little bit higher because this company did a share consolidation. You can see it tried to get above $102 twice, once in September 2018 and then again in July 2019. Just before COVID-19, it actually succeeded in getting above $102, but then unfortunately, COVID-19 sent the share price down. But just after COVID-19, the share price zoomed past that resistance level on quite good strength, a massive long candlestick. On the week, it went above that resistance level. So that resistance level was broken. That's the sort of thing you want to see when a resistance or support level is broken. You want to see it break on strength. However, the share price has tumbled since the start of this calendar year, and during, say, May to July, that's resistance support level now, because once resistance levels are broken, they become support levels. And during that May to July period, that support level at $102 was tested 5 times. Tested 5 times. So the market set the share price down $102, and as soon as $102 was approached, we saw buying coming in. You can see the buying just with the individual candlesticks on those weeks. There's a long tail to the downside, so a lot of buying. And we are again approaching $102. Share price now is around about $106. So maybe this support level will hold firm because it is fairly strong. It was tested 5 times during that May to July period. So if this support level is broken, that would be a bearish sign moving forward for this company. And then the next support level would be around about $82, which was the bottom of the COVID-19 financial panic. Now onto Under Armour, and the only reason I include this company is because I love their running clothes. You might see me on quite a few occasions doing a video wearing some Under Armour shirts. Now, unfortunately, I do find Under Armour running gear to be the most expensive. So we're talking about Under Armour, Nike, what other ones do I like to buy? Some other ones, but I do try to focus on Under Armour when they have specials. So I'm really interested to see where Under Armour share price is right now, because the share price of Under Armour is at a multi-year low. Not only a multi-year low, almost a multi-decade low. So this is traded on the New York Stock Exchange. Markup is only 3.1 billion, which does favorably compare favorably to Nike. I think Nike has a markup is over $100 billion. P/E ratio 11.8. Unfortunately, when you look at the revenue growth, only 0.5% per year over the past 5 years. So this company has had struggles to grow over the 5-year period. But the share price has dropped 76% since November 21. And then I looked at the chart, and there's a really strong resistance and support level at $8. So this is the monthly chart for Under Armour going all the way back to 2007. Maybe that's when it's listed. And that support level and resistance level at $8, because it can be support and resistance based off where the share price is compared to that level. It actually developed way back in 2007, because you can see the share price reach $8 and then pull back during the GFC. But then it moved above $8 in 2011, and you can just see the share price going sideways. So it's continually testing $8 over about a 8-month period. And as soon as all those tests succeeded, the share price then zoomed higher. In fact, it went from $8 all the way to a high of $52, which was reached in 2015. Unfortunately, this company seemingly has been experiencing some problems in their business. That's why the share price has dropped considerably since then. But again, $8 was tested back during the COVID-19 financial panic. And in 3 successive months, the share price fell below $8 and then rallied in 3 successive months. So again, that support level held firm, and their share price rose from $8 all the way to a high of $26. But again, the share price has fallen back, possibly again because of troubles in the business. The share price held above $8 for 3 consecutive months, but 1 month ago, the share price fell through $8 on strength. So you can see a fairly long candlestick on that day, and the share price now is just above $6. So it does look like that support level at $8 has been broken. Now it's resistance, but I'm fascinated with just the valuation of this company right now. P ratio of 11.8. More than likely, I think the market is suggesting that's won't fall, but the revenue, the profit of this company will fall. So I'm going to have a closer look at this company. I have never had a look at Under Armour and their financial state. I just like their clothes. So I'm going to have a closer look. Maybe this is a bargain right now. No way I could say at this point in time because I haven't had a look at the business itself. I just know the stuff about their clothes. Next company I want to look at is Block. They used to be called Square. In fact, their ticker code on the New York Stock Exchange is still SQ. And you could actually buy Block shares on the ASX because they are dual listed. And the reason they're dual listed is because Block is the company that bought Afterpay. And as a part of that acquisition, they wanted Block shares to be able to be traded by Australians on the ASX. Market cap of Block is $34 billion. No PE ratio because this company is loss-making at this point in time. They might be cash flow positive, but I'm unsure about that. But when you look at their revenue growth, this tells you why this company was full of hype in 2020 and 2021. The 5-year growth in revenue is 47.6% per year. That is absolutely fantastic growth. But what I want to see, and no doubt what the market wants to see, is the company able to translate that growth in revenue into increasing profit, increasing cash flow. And maybe at this point in time, the company has not shown that. And that's why the share price is down 82% since August 2021. Now, I've included 2 support and resistance levels on this particular weekly chart for Block. The first support resistance level is at $90, and that's the stronger level. The second resistance and support level is at $40. In fact, that's a support level only at this point in time. Now, let's have a look at the first support level or resistance level at $90. It first was put in place just prior to the COVID-19 financial panic because that was a high in Block's share price. And then share price zoomed past that level back in, say, June of 2020 and remained above that level until recently. But if you go back to, say, February this year, that level was tested. And the share price fell below that level for a brief period of time in 1 week and then moved high. So again, we saw a bounce off a support level. Again, resistance support levels work all the time. They're really strong technical signals. And then in, say, June, May, the share price fell through that support level on really high volume. So the best way for a resistance or support level to be broken is on high volume. I see this all the time. And then that resistance or support level became resistance. Share price fell towards the second support level at $40 and then rallied. And what price did the share price of Block rally to? $90. It tested $90 in 3 consecutive weeks. It failed that potential breakout and the share price has pulled back. It is now moving towards $40, which is a much less strong support level because the only reason I got that support level is because that is the low in the share price during COVID-19 financial panic. So it remains to be seen if that is a strong support level. If we see the share price struggle to get through that level, that will be confirmation that $40 is a strong support level at this point in time. So that's all I'm looking at right now with Block shares. At this point in time, I'm not interested in this company, even though they have revenue growth of 47.6% because they can't translate that revenue growth to profit at this point in time. One company I am interested in maybe taking a position is Zoom. I think the market is completely overreacting when it comes to this company. I'm using Zoom right now to record this video. Listed on the NASDAQ, market cap 25 or 21.5 billion, PE ratio 23. So this is a profitable company and they do generate cash flows in their business. And then you look at the 5-year growth in revenue, 131.5%. Oh, that's a little bit misleading because of what happened during COVID-19. And it won't be able to continue. There is no way Zoom could continue that growth in revenue, but it's still impressive growth over a 5-year period. But the share price has dropped 88% since the high in October 2020. What happened in October 2020? That's when vaccines came not into being, but that's when we first saw the signs that we're going to be vaccinated against COVID-19. So this is definitely a COVID-19 beneficiary before we got vaccines, and that was the top in the hype around this company. Share price reached a high of $580. Didn't quite get to 600, very close to 600. Current share price of this company is now below $80. So the reason why, well, there's a couple of reasons I'm interested in this company. First is their business. They're profitable. They're growing. I think that growth will continue because Zoom and what they're providing is good. And a lot of people use Zoom, maybe Microsoft Teams. That's something else people might use. But Zoom does seem to be the preference, and I think they can continue to grow for the long term. But the share price is moving towards a nice little support level at $60. That support level was developed back in 2019 before COVID-19. In fact, you can't see a COVID-19 blip in the share price for Zoom. So the market's fully aware this company was going to be benefiting from COVID-19. But that support level was developed twice or even 3 times because share price really struggled to get below $60. It bounced off it 3 times. So if the share price falls below $60, that would be a bearish signal. But a low risk buy for Zoom is taking a position just on $60, or if we do see a little bit of a bounce, and that could be a nice way to take a position in this company. I would prefer to see the trend in the share price turn around. I would like to see some sentiment, positive sentiment coming into the share price, but if you do want to try to pick the bottom, maybe $60 is the bottom in Zoom's share price. Next company I will look at is Spotify. I have no real interest in taking a long-term position in this company simply because I don't think they have a moat or a competitive advantage. A lot of competition in this space. But when you look at the revenue growth, 24.5% per year over the last 5 years is impressive. Markup of only $11.5 billion. They are not profitable, maybe not even cash flow positive. So this is one of the reasons why this company's share price has suffered and fallen 79% since March 2021. This company is listed on the New York Stock Exchange. I think Spotify is Swedish, I think. So, but they're still listed on the New York Stock Exchange, just like Atlassian is an Australian-based company, but they're listed on the NASDAQ. Anyway, really interesting when you look at Spotify's share price, it is at an all-time low. So maximum pessimism when it comes to Spotify. Share price has dropped from $390 to $80. And in the last 3 weeks, the share price has fallen through a support level, not a particularly strong support level because we're at all-time lows, and that support level at $90 was an all-time low in regards to share price anyway. But the reason why that was a support level is because the share price did rally off that level 2 times in the past, we'll say 6 months, and then it has fallen through that support level in the past 3 weeks. So at this point in time, all-time low in the share price of Spotify. The only reason I'd probably buy Spotify at this point in time is if I'm bullish on the overall business, and I think $11.5 billion for this company is cheap, or if I do see a shift in sentiment and a change in the trend in the share price. And definitely we're not seeing that at this point in time. So the only reason I'd buy Spotify would be if I was very bullish about the long-term future of this company. Next company I want to look at is Qorvo. This is a semiconductor business. Now, if I'm mistaken in anything I say now, forgive me because I haven't done much research on this company. However, the little research I have done makes me want to do more research on this company, particularly based off the valuation of Qorvo right now. So semiconductor business, primarily in regards to smartphones. So I could be mistaken. Anyway, Qorvo is listed on the NASDAQ. Markup 8.2 billion. P ratio 11.1, which does seem low for a company that has grown their revenue at 12.3% per year over the past 5 years. That sort of growth rate, even though it's not quite as impressive, let's say Block, Zoom, or some of these other companies like Spotify, 12.3% growth in revenue is able to be sustained at a longer time frame than growth rates of, say, 20% or longer. So I do like companies that are able to consistently grow their revenue at 12% per year for the long term, which Qorvo seems like they are doing. But the share price has dropped 60% since August 2021. So the other reason I'm interested in Qorvo is because a lot of other semiconductor businesses have seen significant drops in the share price. So this is, or there is a lot of negative sentiment in this particular sector right now. Now, when it comes to Qorvo, I've included, and this is the weekly chart for the company going back to 2016, I've included two support and resistance levels. The first one at $85 is the one I'm going to focus on right now. I'm going to ignore the other one, which is around about $58. So 85 support level and resistance level for this company was actually created or started way back in 2018 because the share price of Qorvo really struggled to get above $85. It tried to in the first few months of 2018, but then it succeeded to getting above $85 in October of 2019. You can see that one candlestick, really long candlestick, when the share price of this company went above $85 on really high volume. So that was a really strong, powerful break in above that support or that resistance level at that point in time. Unfortunately, the share price then fell through that now support level during COVID-19 financial panic, but only remained below that level for a brief period of time and then zoomed past with a V-shaped recovery. In fact, the share price went from $70 all the way to a high of $200. But the share price has moved into a really well-defined downtrend and has decreased from $200 to a current share price of $80. Now, even though I'm going to do a little bit more research on this company because based on valuation reasons, this company might be looking attractive. However, in saying that, the share price has fallen through $85. So it was a support level. Now that support level has become resistance because the share price has remained below $85 for 4 consecutive weeks. We have seen it tested on 3 occasions, but those tests have all succeeded because the share price has not got above $85. So now that support level has become resistance. And then the next possible support level is around about $70, which is the bottom of COVID-19 financial panic. And then we also see another really good support level at around $58. So right now, even though I'm going to do a little bit more research on this company, and even if I think there could be some good value at current share prices, I might be a little bit hesitant just because of technical reasons, just because the share price has broken below a really good support level. Next company I want to look at is Adobe. Now, the reason I've included Adobe in this particular video is twofold. First, the valuation, P/E ratio has dropped below 30, and that has got me interested in this company. The second reason is because the share price is hovering around a pretty good support level right now. So let's talk about this company. We won't talk about what they do. Most of you should know what they do. So listed on the NASDAQ, market cap 134 billion, P/E ratio, as I mentioned, 29. And when you consider the growth in revenue over the past 5 years, 22.9% revenue growth. That's really impressive revenue growth. And if they can continue that, a P/E ratio of 29 is dirt cheap for this company. Share price has dropped 60% since November 21. So over the past year, the share price of this company has dropped 60%. And about 4 weeks ago, the share price dropped a lot. In fact, it dropped from just below $400 to $300. Must have been some negative news because that was on really strong volume. So I can't remember what it is, but I do have in the back of my mind something about Adobe about 4 weeks ago. Maybe it was an acquisition or something, something like that. Anyway, the reason I'm interested in Adobe, apart from the valuation, is that $280 is a pretty good support level. That was the lows we saw during the COVID-19 financial panic. You just see the share price over the past 3 weeks has hovered just above that support level. So it's really testing that support level to see if it remains firm. So there would be some investors out there, some traders out there who know $280 is a strong support level and they get a little bit excited and they're buying this. But if we do see $280 break, and I think there is potential we might see a break just because of what happened 4 weeks ago, that would be a bearish sign moving forward for Adobe. Wouldn't be surprised to see it broken. Wouldn't be surprised to see this level remain strong. But I think the overall market will be very important moving forward for Adobe. If we see further drops, further negative sentiment in the overall market, I think we might see further downside for Adobe. And that's actually also true for other companies I'm featuring in this video. Next company I want to look at is also a semiconductor manufacturer, Intel, listed on the New York Stock Exchange, market $108 billion. I could be mistaken, but I think the valuation of this company was higher during the 99 tech bubble. I could be mistaken, but I have a feeling it was. So this company has been around for a while. P ratio 5.7. I thought that looked really, really fishy. Seemed way too low. So I got my numbers from TradingView. So I Googled what is the P ratio of Intel, and I got a lot of really low numbers like 5.8, 6.2. I also got a 9. So I'm going to have a closer look at Intel because 5.7 P ratio seems really low for a company that has been growing their revenue at 10.3% over the past 5 years. But the share price has decreased 62% since April 2021. And the share price decrease has accelerated over the past 2 months. You just see the share price has really decreased at a sharp rate, at a fairly sharp incline over the past 2 months. And the share price has reached a pretty good support level at $25. And we have to go all the way back to 2015 to see the last time the share price was this low. And that was the setup of this support level. And the share price in the past week did bounce off $25. So again, there would be chartists out there, people who look at charts, who saw the share price of Intel moving towards $25. They noticed that the last time the share price was this low was way back in 2015. The share price bounced off that level. So they would know that a good time to take a position in this company is at $25. And that's why we saw the share price of this company bounce. Doesn't mean the $25 will remain a support level moving forward. I wouldn't be surprised to see $25 tested numerous times in the future. But wouldn't also be surprised to see, because of the rapid decrease in the share price, a really good bounce in the share price. Wouldn't be surprised to see the share price bounce from $25, $26 back to, say, $32, $34, because without doubt, shares in Intel right now are oversold. So if you want to take a short-term position to catch that bounce, to benefit from that bounce, right now might be the time to take a position in this company, a short-term position. The last company I want to look at in this particular video is Visa. You probably also could include MasterCard, because when you look at the charts, very similar charts, very similar companies, but Visa and MasterCard are the sort of companies I would love to own for the long term for numerous reasons. They are a duopoly, and I do believe, in my opinion, they have almost the perfect business model. So Visa right now listed on the New York Stock Exchange, market cap 378 billion, P ratio 27. So that's the first reason I'm becoming more interested in Visa, is the P ratio, or the valuation of this company, has been pulling back because the share price has dropped 30% since July 2021, and the share price of Visa is in a well-defined downtrend right now. And then the other thing is, when you look at the revenue growth, 11.2% revenue growth over the last 5 years. Now, in my opinion, and I don't think there's any research being done on this, the ideal growth in revenue is between 10 and 20%, because I believe if you can grow your revenue at between 10 and 20%, that is more likely to be sustainable in the long run. When you see revenue growth of, say, 30, 40%, a company can't maintain that sort of revenue growth. More likely it's going to pull back. But if a company can maintain growth rate of 11.2% for the long term, that company will be a good investment for the long term. That's just my opinion. And then it all comes back to valuation. So P ratio of 27 might be still a little bit too rich, but with revenue growth of 11.2%, I think this company is starting to look more and more attractive. Now on to why I'm included this company in this video, apart from the valuation. The first reason is because of the long-term downtrend, which set up back in July or August of 2021, so 1 year ago. And the reason that's a really good trend line, and that's portrayed by that sloping dashed line, is because every single time the share price of Visa approaches or nears that trend line, we see the share price pull back. It has happened 1, 2, 3, 4, 5, 6, 7, 8 times in the past, and then the share price keeps on dropping. So that means that trend line is a really strong trend line right now. The other reason I've included Visa in this particular video is because of support resistance level at $189. The reason that is a strong support level that has been broken recently, now resistance, is because 5 times in the past, we'll say 11 months, that support level was tested 5 times. You can see the share price reach $189 and then share price bounced each and every time. The most recent time was about 5 weeks ago, and then the next week it tested again and then that support level was broken and the share price kept on falling. In fact, it broke on pretty good volume. So there would have been a lot of chartists out there who knew if $189 was broken, that would be a bearish signal, and they got out. That's why the share price kept on falling. So right now, we have seen the share price remain below $189 during the past 8 weeks. So we can confirm that that support level has now become resistance. So the next level I'm looking at is around about $140. If the share price of Visa gets to $140, I will be taking a position in this company. That's all I have for this technical update, focusing on the New York Stock Exchange and the NASDAQ listed companies, featuring 9 companies and 1 ETF. So if you have any questions, any thoughts, any concerns, anything you want to mention about any of these companies in this video, I'd love to hear it. So leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a great day. Talk to you later. Bye.